seeing that large number of people are trying to get into this. So as I said, we have some experience working into this domain. And that's why we wanted to have this common forum, which is known as AnalytixPro, and this is currently being handled by 4 of us. So, so this is something, a background about AnalytixPro and the work we are trying to do. Now, coming to my own introduction, so I would give a brief introduction about myself, and later on I'll pass on the pattern to my other teammates. So myself my name is Shubhodip Guha. So I have a background in statistics. I've done a master's in statistics, and I've been working in the majorly in the BFSI and financial domain for the past 8 years. In August, I'll complete 8 years of professional experience. So currently, I work in Citibank. I used to be in Mumbai. Currently, I'm part of the Bangalore Citibank team. And majorly, I'm currently working with the regulatory models, which are used in the retail space, mainly for scorecards, ECL, IFRS 9, ICAP, etc. And majorly, I work into the retail domain. So previous to my current experience, it will be almost like 5 years in Citi. I've also had the chance to work on various other multinational companies, Indian companies, but mostly in the BFSI domain only, where I have had the chance to work on other sort of models like the scorecard models and other liability side of things like debit card campaigning and let's say ATM cash optimization, where I've had the chance to work on various modeling techniques like machine learning, time series, basics, classical statistical models. So this is a brief background about myself. So coming on to the agenda for today. So Kushal, if you can go to the agenda slide, then maybe I'll give a brief introduction on what we are trying to cover today. So for today's session, we have tried to keep it very simple and in a very lucid manner. We have tried to incorporate the basics of the risk that is associated with a banking or a financial institution. So for that, first what we have tried to do, and like I said, that various people who those are not even in the quant space also are also reaching out to me. So that's why we, to me and to the other folks, we have kept it very simple and very lucid, so that the target audience is able to grasp even in a very simple manner. So this is a very introductory bird's eye view, I would say, on the type of the topics that we are covering. Later on, we plan to have subsequent webinars where we will try to include very nuances and idiosyncratic details of each of the modeling and stuff which goes around within the risk domain. So coming back to the agenda today. So for today, we have with us is first we'll cover what are the various type of risks that are associated with the BFSI and or a banking institution. Then specifically we will be delving into the credit risk part and what do we mean by the credit risk part. And then in the credit risk part, we will further delve into what are the different aspects that the models do.
We will try to create a bill in order to make it more expensive. But तो हम पैसा दे रहे हैं वो भी overpriced दे रहे हैं.
Hello.
Something which is worth maybe 10,000, I'm paying 80,000 for it.
Yeah, guys, can you please go on mute if you're not talking?
सोचो तो किस level of psyche पे.
Okay, I've kept him on mute. No problem. And yeah, I would request everyone, if no one is speaking, kindly be on mute. So yeah, so going back to the agenda. After credit risk, we will delve into the various modeling frameworks of the credit risk and what are the aspects that are seen in each of these areas of credit risk. What are the regulatory landscape? What are the type of models? And these are, as I already told, a very bird's eye view of what we are trying to, convey. So this is the introductory session we are having. We plan to have further sessions where we will delve into more details in each of the topics. So yeah, so for today's session, I will act as a moderator, and my other teammates will walk you through each of these details which I have mentioned here. And before starting into the materials, I would like to give some disclaimers or some infos so that we have a clarity on what we are trying to do. So first of all is that this is the first time we are trying to do this sort of things. Although we have had individual experiences teaching and mentoring other folks, but this sort of common platform we are trying to do for the first time. So we might face some technical glitches. So I would request everyone's patience and cooperation for that. And another thing is we will be recording this session, and we might use some snippets of these sessions for our internal purposes. I'm hoping that would be fine for everyone. And like I said, everyone, I would request to be on mute, and anyone who is speaking, they can unmute themselves and ask any sort of questions. And the main thing I would like to say is that we would like to be this as a two-way street. Like we will also try to convey whatever we know from our knowledge perspective. We will also like to be it as interactive as it can be. We'll also any questions, any queries, anything add-on would it will be highly welcome. So I would request everyone to pitch in and ask questions. We'll have a separate segment Q&A at the end of this session. But anyways, within the course or within the webinar, if you have any questions, you can always chip in and we can always answer your questions. So yeah, I think I have given brief overview of this. So, but again, the introduction of my other colleagues are pending. So I would request each of my other colleagues to kindly introduce themselves and what exactly they are doing, and then maybe we can dive on to the core of things which we're trying to do. Thank you. So yeah, Kushal, if you can start.
Yeah, sure. Thank you, Shubhadeep, for the introduction. So I'll quickly talk about myself. My name is Kushal, and I have been in the risk analytics domain for around 8 years now. I am right now. I'm working with HSBC. I'm a part of the IFRS 9 model development team, which basically comes under credit risk modeling. And previously I have had a chance to work with different major banks and consulting firms as well, mostly around risk analytics and especially credit risk analytics. And yeah, as Shubhati mentioned, the motivation behind these sessions is again comes from the passion of passing on the knowledge that we have learned from all these during all these years. And hopefully we'll have a good session today, and you guys get to take back something out of this webinar. So maybe Krishna, you can go ahead and introduce yourself.
Yeah, thanks, Kushal. Thanks, Shubhati. So, hi everyone, this is Krishna. So, to give a brief introduction of myself, so I have around 7 years of experience in risk analytics, and most of my work has been around credit and market risk. And currently, I'm working with UBS, but that is on the economic capital models or operational risk models currently. And before that, I was working with Citi in the CCAR loss forecasting team for the retail models. And prior to that, I was working with CRISIL, and there I worked on a few credit and market risk models. So I'm looking forward to this interactive session with you all, and I would request you to, provide your opinion, your views on whatever we discussed today, so that it's both way. Um, like both, all of us gain something out of it. So thank you. Over to you, Arithro.
Hi everyone, my name is Orithro. So I am in the credit risk analytics domain, uh, primarily focusing onto the BFSI for around 8 years. So presently I am with the Standard Chartered for their IFRS 9 model development team, and looking forward to this webinar and hope to see everyone's inputs so that we all can grow together. Thank you.
Thank you. Thank you everyone for the brief introduction. So yeah, with the further ado, I would say we will quickly dive on to the agenda slide we are currently presenting here. So majorly this would be driven by Kushal and Krishna for today's session. And wherever we feel we might chime in on the things, we might also have some further inputs on that. So over to you, Kushal, maybe on the introductory stuff. Yes.
Yeah, sure, Shubhadeep. So, okay. So let's get started though. You can see the few pointers here, the agenda that we'll cover. So let's start with risk first. And before I get into the discussion over here, again, just want to reiterate that please make it as interactive as possible. We have come up with this webinar so that everybody can take something out of it. And I personally believe that you only get to learn when you ask questions. So please do ask questions. We are happy to answer. So yeah, so let's go ahead now. So the first question that that we want to answer here is, what is risk? Right, we all have heard of risk analytics, risk modeling in the industry. But if I want to put it in a very simple manner, risk is basically the possibility or the probability of any kind of loss that an institution might incur. And that loss can be in the shape of let's say a financial loss, or it can be a reputational loss, or any other form as well. Right, majorly it is about the financial loss that the banks or any lending organization is concerned about, but it can be in other forms as well. So that, in a nutshell, what risk is. And depending on the different kinds or categories of risk, it can be divided into a few types. So we are going to talk about those few types of risk in this particular slide, give a brief background of what these types are, and then get into the credit risk part, where we'll get into the different nuances of it. So the first type of risk, again, as we just spoke about, it's credit risk, right? And in a very simple manner, credit risk is what? When a borrower goes to a bank, takes a loan, and he fails to repay back that loan. So that is a credit risk loss for the bank. And the bank really needs to understand what are the chances of credit risk, what are the losses involved, and what are the actions that the bank can take to mitigate those losses. So this is what the credit risk is all about from a bank's perspective or a lending organization's perspective. There are various nuances to it around how to identify the risk, how to measure them, and once it's captured, how to take certain actions to reduce this or minimize this risk. So we'll talk about all those details in the next slides, but this is the brief idea of what credit risk is. Apart from that, the next one would be market risk. So as we all know, we deposit most of our money in banks, and the banks in turn invest those money in the market to earn some income out of it. But there are ups and downs in the market, as we all know, right? So if there is something wrong going on in the market, in the economic conditions, those financial investments of the bank are at risk. And if the no there are certain losses that come out of those financial investment, that is a risky proposition for the bank. So the bank really needs to understand what are the market risks around the financial investments that the bank is making, and make sure that the risk is minimized there. There are few standard methodologies to evaluate market risk, like VAR is one of them, value at risk, which some of you might have heard of. But yeah, so that is the main idea of what market risk is. The next topic is the next type of risk is operational risk. So this is something that happens when there are certain failure in the process or the system in which the bank performs. So I can maybe take an example of one of the major banks in the US. So recently, in the recent past, there was an incident where the bank transferred something around 500 million of cash to a certain account, where they were supposed to only send 5 million. So that was a system failure, some malfunction in the process or in the system that made this happen, and this is a huge loss for the bank. So to ensure that such operational failures are not happening, there has to be an operational risk team in place which takes care of this aspect and tries to minimize the loss operationally. Okay, the next would be liquidity risk, right? So what is liquidity? So when a bank is in need of some cash, the bank should have enough assets or liquid assets which the bank can use to meet those payment obligations, right? Although the bank can have different kind of assets, like some long term investments, some real estate, those cannot be liquidified to cash very instantly. So the bank needs to keep aside some liquid assets or some cash, to be specific, whenever certain situations arise, so that they can use it. Again, one more example can for this liquidity risk can be, if you have heard of Silicon Valley Bank. They went into this huge issue where they had to meet certain payment obligations, but they were short in liquid cash because most of their investments were stuck in long-term investment plans. So that was something which was in the news, and that was primarily due to the liquidity risk aspect of it. So that is something very important, and the bank needs to pay attention to it. Apart from these few types of risks, there can be other risks as well. Let's say climate risk. So I'm sure some of you might have heard of it. It's the hot topic in the market right now, climate risk, and a lot of banks are trying to figure out different methodologies to estimate climate risk and work on it. So that is another additional type of risk. There can be other risk types as well, like compliance risk or reputational risk and so on. So all of these need to be measured and contained in some manner for the bank to survive, or let's say not to go bankrupt in an inform, right? So this is a brief idea of what are the different types of risk are. However, in this particular webinar, we are going to mainly focus on the credit risk aspect and talk about the different nuances of it. Okay, so
I think Jennifer has one question. Yes,
yeah,
there.
sure, Jennifer, go ahead.
So yeah, Jennifer.
Yeah, I just wanted to ask, like you mentioned, the liquidity risk.
Mhm.
So I just wanted to know, like, what are the tools that a company uses to know that like cash they should keep in order to mitigate the liquidity risks.
Right.
So,
So
Jennifer, one request if you can introduce yourself.
Oh, my name is Jennifer Sophia Kajur. I have studied from St. Xavier's College, Kolkata. I'm a recent graduate and I'm interested in this field.
Thank you.
yeah. So Jennifer, so okay, that's a good question. So when we talk about the liquidity requirements, so when a bank is functioning, they would have certain ideas. What are the payments they need to make from time to time? There can be various kind of payment obligations. Let's say a customer who has deposited let's say FD or something, he wants to withdraw that. That can be a liquidity requirement. Some other payments to some other vendors or something like that. So the bank usually plans for those liquidity items, which it has, let's say in the next quarter or the next 6 months or even the next year. So those plans are set in place, and whatever capital requirement or whatever liquid cash requirement the bank needs to have or is expected to have for meeting those payments, the bank needs to keep that aside in some form, right? So let's say the bank predicts that in the next quarter I have to meet liquid payment requirements of $100,000. So the bank has to keep that aside. They can't really put it aside in some long term investment and hope that the requirements doesn't arise and they are okay with it. So they can't do that. So when the requirement arises, they have to take out the cash and make those payments. So it's more about planning for those requirements and keeping that kind of cash or capital aside. Does that answer your question, Jennifer?
Yes.
Okay. Okay. So, so I'll move ahead. Quick move. Yeah. Anybody else? Okay. Fine. So, all right. So let's move ahead. Uh, I'll maybe pause after the next slide again and take some questions from you. So here, so as we mentioned, as Shubhadeep also mentioned initially, we're going to mostly focus on credit risk today, right? So the first question is, what is credit risk, right? So as I mentioned briefly before as well, so there's a bank, and someone goes to the bank asking for a particular loan of some X amount, let's say, and the bank initially would assess that customer whether the loan can be given to that particular borrower or not, and then eventually grants it. Let's say the loan is granted to that particular borrower, and when that borrower fails to repay back that loan at some point of time, the loss that the bank incurs, that comes under credit risk, right? Borrower failing to repay a loan, the possibility of financial loss arising from that is credit risk. Now, one thing to mention here, when I talk about a borrower, the borrower can be an individual like you and I can go and ask for a car loan maybe, or it can be another institute who are trying to run a business. They can go to a bank and ask for a loan as well. So when an individual is asking for a loan, that comes under the retail space, retail credit risk. When an institution or an organization is asking for a loan, that comes under wholesale credit risk space, right? Although the different aspects or components of these two, retail and wholesale credit risks, are somewhat similar, but there are quite a few differences as well. So for simplicity, going ahead, and for no, since we are all individuals, we probably naturally understand the retail space better. We will take examples of examples which are more aligned to the retail space from an individual point of view to explain all the components that we're going to in this webinar, right? Okay, so coming back, so as I mentioned, the borrower takes the loan, fails to repay the loan, and credit risk arises. So this is the answer to what is credit risk. Now we have to understand why this credit risk happens. What are the drivers for a customer to not repay back the loan? There can be multiple factors, right? The first one would be loss of income of the borrower. Let's say I go today to a bank, I take a car loan. My EMI to pay per month is 10,000 rupees, and I have a, let's say, a salary of 1 lakh rupees per month. I am happily paying the loan. Let's say 6 months later from the date of taking the loan, I lose my job, right? I don't have a salary anymore. What happens is that I cannot pay back my loan anymore because I'm not getting any salaries. I have other basic needs to take care of. The loan is something becomes a liability for me, right? So the loss of income of a borrower, or let's say deterioration in the financial health of a borrower, can lead to credit risk, right? So that is number one. Number two can be change in economic conditions, right? So let's assume a recession kind of a scenario. We all have heard of 2008 when there was a big recession, or even the COVID couple of years back, right? Where the economy just took a nosedive. It went for a toss. There were there were not much of profits in the different businesses and everything. Some employees or some working people got their salaries halved down. Some people lost their jobs as well. So the economic conditions can also indirectly influence the payment behavior of a customer, right? So if there is a recession or something like that, the economy is not working fine, that can impact the payment behavior of the customer, and he can fail to repay the loan. That is the second driver. The third driver would be, that is a very important driver though. So that is basically the lack of judgment of the borrower at the time of granting the loan. So when a applicant comes to the bank asking for a loan, it is the responsibility of the bank to assess the credit worthiness of the customer. By credit worthiness, I mean whether the customer or the borrower has enough financial health to pay back the loan or not. If this assessment is not performed well enough, it can lead to some kind of a loss later, because if I give away loans to some customer who doesn't have the capacity to repay the loan, then of course he would fail at some point or the other. Even in the 2008 recession, there were examples of so many bad loans being given away without proper assessment of the borrower. So that can be a huge driver into to lead to credit risk, right? There can be other factors as well, like rise in interest rates and other factors which can influence the behavior of or the payment behavior of a customer. But these are the mostly, or the high level drivers that can be there to leading to credit risk, right? So we have understood what are the drivers, what is credit risk, what can lead to credit risk. Now we have to mitigate them from a bank's point of view. We have to understand, we have to measure and take actions. For that, we need credit risk models, right? We all have heard of credit risk modeling. So what are these credit risk models? This entire modeling landscape that we have under credit risk can be classified into two major categories, right? There are so many models within credit risk, but we have tried to broadly classify into two categories to begin with. The first one is decisioning. The point that I just mentioned a while back, to assess whether a customer is credit worthy enough to be granted a loan or not, right? We don't want to, the bank doesn't want to grant loans to risky borrowers, because at some point of the other they might default, or they might not be able to pay back the loan. So to make this decision whether, when an applicant comes, I would want to approve the loan or reject the loan or not, is a very important piece in the credit risk domain, right? So uh, so now in this decisioning aspect, one point that is the kind of models that are used are called scorecards. We'll talk about the scorecards in the next slides, but yes, in a nutshell, the decisioning aspect is where you get to judge the credit worthiness of the customer to decide, as decisioning, as the term decisioning means, to decide whether to give away the loan to a customer or not, right? So let's say we have, or the bank has cracked the decisioning part. They have figured out uh, like how to do the decisioning, how to lend only to good customers and not the bad customers. Okay. They say today we identify in this month 100 good customers, which the bank believes are good customers, or the scorecards tell you these are good customers, and they do the lending. But today they are good customers. There is no assurance that 1 year down the line they would still have the same financial health, right? So there comes the need of loss or reserve management, because no matter how strong a decisioning system I have, or how much we try to lend only to good customers, there would always be some customers who would default basically means failing to pay, right? uh, some customers would always default at some point in time, and there would be some losses that come out of it, right? So the bank needs to measure which something called as the expected credit loss. Basically, if someone goes into default, what is the loss I'm going to make out of that customer, and then we accumulate it for all the customers that I have in my portfolio, right? That is the expected credit loss that needs to be measured, and some action needs to be taken on it, which we'll talk about later. Okay. Now, this is a very normal scenario. As I said, out of 100 customers, 5 or 7 or 10 maybe will default, and some losses will be there, and we measure it in terms of expected credit loss. Now, there can be some severe situations as well. Again, the example of a COVID situation, or the 2008 recession, or any other recessions that we ever had. So in those situations, that's an extreme situation, or something which we call as a stress situation in banking terms. So for that kind of a situation, we need to plan separately, because when a stress situation comes, which we don't really know when it will come, but if it comes, what are the kind of losses that we will make, and that will be much higher than the normal expected credit losses, and we need to do certain capital planning around them as well, right? So that is what loss or reserve management is all about. So just to summarize, two aspects to it: decisioning, how to decide whether to grant a loan or not. Once we have granted the loan, how do we make sure the losses that might arise in the future, that is measured and contained? Yeah. So
So Kushal, there is one question in the chat: to what extent is AI or ML used to assess creditworthiness of borrowers?
mhm.
It is not a manual process, I'm assuming. So this is from Bhargav.
Okay. So hi Bhargav, thanks for asking that question. So it is not a manual process anymore. To answer your second question, yes, it is not a manual process anymore. It used to be. Now there are models around it. Now the models again can be classified as more statistical models, let's say logistic regression, versus very hardcore machine learning or AI models. So from what we have seen in our experience, big banks who have a lot at stake, huge money at stake, they are not yet fully reliable on AI or machine learning techniques, because as you would know, the AI and ML techniques are somewhat of a black box. We don't really know what's going inside them, right? It's very difficult to interpret or explain the outcome of a AI or an ML model, and you are talking about lakhs and crores of rupees which you're lending to customers, and you are ready to take that bet based on some model which you cannot explain in the first place in terms of the business requirements. So that is a risky proposition. So usually the big banks are avoiding the AI and ML space today. As of today, I don't know what the situation will be later in a few years, but as of today, they are not into the AI and ML space as far as credit risk is concerned, right? There can be other aspects, marketing, propensity, all those things, like whom to target to sell a loan. Credit cards, you might get 100 calls every day to get a credit card or a personal loan. Those kind of things are being driven by AIML for sure, because there are lesser risky, less risk of loss involved there. Only loss is you just call a customer, he doesn't take the loan, so very minimal loss, only the cost of the phone call maybe. But when it comes to lending, it's a very risky space, and not sure the banks are ready to take that bet on something they don't understand yet. Hope that answers your question, Bhargav.
So I think it has. These have
Mhm.
replied thanks. So maybe if anyone
Okay.
else have any
Yeah.
questions, otherwise we can. Okay, we have another question.
Hmm.
I do not know the name. So, okay, I'll just read out the question. Do institutions build risk models on reputational risk inputs as well for trying to project how much of a loss they can suffer from an event or decision?
See, when it comes to reputational risk, it is something that is that cannot be measured by data alone. Of course, there can be some data in the past where the bank has taken certain decision which has led to some reputational or image loss, but it's very difficult to measure that by data points, because there would be, firstly, there would be very small data points, and you don't know if some new data point comes in the future whether that will have a reputational risk or a risk of reputation loss or not, right? So it will be backed by data somewhat, but it's going to be largely expert driven, because as you can understand, reputational risk can arise from anything. Some statement the CEO makes or some policy changes the bank makes, that can have a adverse effect. It has a lot to do with the sentiment of the people, or all the of the country or of the region. So there can be some data driven or statistical models to it, but largely it is judgmental or expert driven, and banks do have people, teams to work on it.
So yeah, just to chime in on what Kushal said, I mean, I totally agree with what he's saying. So just to give an example or a flavor, so some people of you must have already worked in some capacity in some corporate. So if you see, we might be getting some regular mails, monthly mails about reminding us of the policies on how we can interact with the media, what we can say, what we cannot, what are the confidential documents which we can see, which we can uh, publish. So let's say on the social media, we cannot just put up anything from the office space into the social media, right? Or you cannot just go to the media and say anything about the organization you are working in. So these are the sort of mitigation plans which are in place, like Kushal mentioned. These are the specific team related who looks after this. These are mainly uh, mitigated by this sort of process. But yeah, to summarize, this largely mainly qualitative and this are not quantitative. I would say. Yeah. Kushal, anything else, or
No.
the one who has asked the question, does that answer
Yeah,
the question?
yeah, it does suffice my question. Thanks.
Okay. Thank you. Yeah, you can proceed, Kushal.
So if we don't have any more questions, maybe I'll move to the next slide. Okay. So, okay. So as we spoke here about the different model landscapes, one is the decisioning, other is the loss management. So we'll start with the decisioning aspect first, because that comes first in the credit life cycle. So, right. So as I mentioned, for the decisioning aspect of it, scorecards or credit risk scorecards are something the banks develop to help address this decisioning challenge, right? So what is a credit risk scorecard, or what is a credit score? I'm sure all of you have heard of CIBIL score, right? CIBIL is a credit bureau and they have a score. And there are other credit bureaus like Experian or Equifax. They all have credit scores, and credit scores are nothing but a 3-digit score. That's what it is generally, which ranges from around 300 to 900, and it tells you the financial health of the customer, right? Or the capacity of the customer or the borrower to repay back a loan. So higher the score, it means the financial health is good for that customer, and he's in a good shape to repay back the loan if he is granted the loan. And someone who has a lower score will mean the reverse, that is, his financial health is not good. He might not be able to repay back the loan if the bank grants a loan to him today, right? So that is how the credit score is or that is how it looks like, or how is it interpreted, correct? Now, credit score initially can be classified into two broad categories, or scorecards can be classified into two broad categories. One is a generic scorecard versus custom scorecard. So the example that I just took of CIBIL score, right? It's a credit bureau score. And these credit bureaus are those institutes to whom every bank send their information. Like today, if I hold a credit card from HSBC, I have a personal loan from State Bank of India, and I have a car loan from, let's say, Citibank. Okay. the credit bureau will have all the information about all my loans from all these banks. And using all this information, they will develop a scorecard, which is generic in nature because it is a combined scorecard of all my different kind of loans, all my portfolio, that is car loan, home loan, or credit cards, right? And it can be accumulated over the entire country as well, or all the banks together. So they're not specifying any particular bank or any product or any region. They are doing it at a generic level. All the customers can combine. So that is a generic scorecard, which the prime example of it is the credit bureau score, and that's developed on the entire portfolio, let's say, of all the customers then in the entire country of all banks. Now let's come to the custom scorecard. It is something the bank would develop for themselves because they want to understand how the customers are going to behave for them. Let's say HSBC Bank operates in UK as well as India. They have, let's say, credit cards in both the regions. They would want to develop a scorecard on credit cards only, or maybe unsecured loans only, for one for UK and one for India, because they believe the payment behavior of these two regions are different, right? Or let's say, if I talk about a product classification, they might want to have a scorecard for mortgage or home loans versus a credit cards, because these are two different kind of loans, and the payment behavior might be very different for these two products with respect to a borrower. So they want to target specific products, or build scorecards on specific target audience, because that's where they want to build their market on, and that comes under the custom scorecard category. So that is the generic versus custom. One is very generic, and custom is specific to a particular target audience, or a particular bank, or a particular portfolio, right? So that is basically that answers my question to what is a what is a credit risk scorecard basically. Now the second question is, why do we need a credit risk scorecard in the first place? What is the use of it? So we have been talking about the decisioning part, right? Whether to grant someone a loan or not. So that is the primary goal of a scorecard, that it will tell me whether I should give this person a loan or not. Now if I rephrase it in a different way from a bank's perspective, what they basically want to do is, they want to maximize their approval rate and minimize their loss rates. What do I mean by approval rate? Let's say 100 applicants come to me today for a particular loan, let's say, and I approve 80 of them, 80 out of 100. Then my approval rate becomes 80%. Okay, I'm approving 80 out of 100 loans. So the bank wants to maximize this approval rate because they want to make the most of the profit they can. At the same time, they don't want to do losses. So they want to find that optimal number of approval rate where the loss rate is minimum, right? That's what they're trying to do or achieve using the credit risk scorecard, or one of the scorecards that we'll talk about later. But that is the primary goal of a scorecard. There can be other uses of a scorecard, like managing the portfolio risk or optimizing collection costs, etc., which I'll come to in a bit. But the primary goal is to increase the or maximize approval rate and minimize the loss rate, right? Now how do we do it? We know the problem statement, we know how it looks like, but how do we go about developing the scorecard? Just to give you a brief idea, it's a classification model, and mostly logistic regression that gets used. There can be other classification models as well, like decision tree or things. But yeah, it's a classification model where the target variable, or the variable that we're trying to predict, is whether the customer will default in the next few months or not. Let's say next 12 months or not, right? And to predict that, there can be we can use different predictor variables, like customer specific information like age, income, years of experience, all of which that will indicate the financial health of that customer. Or there can be, if the customer already holds a loan with the bank can use those payment information from those previous loans as well, that how he has been repaying the previous loans. That will give an indication whether of how he will repay back the next loan that we will or the bank will give out, right? So that is the how part of it. Okay, now let's go back to the why part again. Like we were talking about, why do we develop scorecards? There are different use cases to it. The first one, of course, I spoke about, and that is what the application scorecard does, right? It helps me decide whom to give away a loan or not. Let's look at this very simple example. Let's say age and income are my two variables in my scorecard. Okay. The first customer or the first applicant who has an age of 35 and has an income of 2 lakhs per month, right? That these are all good signs. 35 means he might have a stable job or something. 2 lakh is a good enough salary. If my let's say EMI is 10,000 or 15,000, he can pay from that 2 lakh salary that he's drawing, right? So the bank would accept it, or the scorecard would give out some score, which would mean that the loan should be accepted or approved. Now, someone who is, let's say, age 21 and has a salary of 15,000. Now, these are very risky figures now. Very low age and maybe just has started with the job, only 15,000 salary. He might not be able to repay back the loan on time. So the bank would reject that loan maybe. And maybe a third customer who is around 25 years of age and a 50,000 salary. The bank is really unsure from the output of the scorecard whether to give him the loan or not. So then it falls in the amber zone where some more digging out has to be done for this particular applicant, and then the decision will be made, right? So this is how a rough idea, a very crude way of explaining how the scorecard works and the various factors that goes into a scorecard, basically an application scorecard, right? So this is something, this is also known as the A score industry in the industry. Okay. So once the A score is done, that is we have decided whom to grant loans. The next scorecard that comes in the credit life cycle is the behavioral score or the B score. Right. So again, going back to my point that I mentioned before, today I've granted the loan. He's a good customer maybe, but I don't know whether he will be in a shape to pay back the loan 1 year down the line, because let's say the loan is a 5 year tenure. It's a car loan of 5 years. Maybe after 1 year or so, the financial health of the customer deteriorates. So we have to keep monitoring that, and that's where the B score comes into the picture to assess the credit worthiness of the customer of the ongoing loans at any point of time in the future, or at any point of the ongoing loans basically, right? So B score can have again multiple uses, as I mentioned, to firstly to assess the financial health or the riskiness of the ongoing loans, if there are chances of any particular ongoing loan defaulting in the near future or not. To understand that, that is the first goal of a B score. There can be other goals as well, like cross selling and upselling. Let's say if my B score tells me someone is having a very good score, let's say 800, 850, something like that, right? So which means that he has been paying back all his dues or all his EMIs in a very proper manner, no missed payments here and there. So the bank might want to pitch him for another loan. So you might have seen that if you have a credit card with some bank and you are spending and paying well, the bank will call you for an add-on card or an increase in credit limit, because that's a way of upselling the product, right? Or sometimes they even call you for a personal loans because you're doing on your credit card. They might want to sell you a personal loan as well. That's cross-selling, and the B score can do that, right? And on the other side, customers who are not doing good, who has a low score, for them maybe they'll certainly take certain other actions to make sure the profits are made before the account goes into some kind of loss. So these are the different aspects or uses of a B score, and that is primarily for ongoing loans. That is when the loans are disbursed, it is on the existing portfolio of the bank. Okay. Now comes the C score, the collection score. So we are done with the beginning point or the origination of a loan where we have decided to give away the loan. We have tracked them in their life cycle. Now comes a point where the customer might have missed a payment or two. That is, the customer might have gone delinquent, some kind of delinquency. What do I mean by delinquency? If I, let's say, miss 1 month of EMI, I am 1 month delinquent, or 30 days past due, 30 DPD, because I missed 1 month of payment, right? If I miss two consecutive payments or two payments, then I'm 2 months delinquent or 60 DPD, 60 days past due, right? So that is what I mean by delinquent. And usually default is generally someone who has missed 4 payments, 90 plus days past due basically. So anyway, so coming back to this, collection scorecard is applicable to those who are into some kind of delinquency. That is, they have missed a few payments here and there, right? And we want to understand, even if let's say they have missed 1 or 2 payments, what are the chances they will repay back those missed payments and come back to being a good customer, right? And the bank makes no loss out of it. Or what are the chances he might not pay back at all. right? So this information is very necessary from a bank's point of view for those customers who have missed 1 or 2 payments or 3 payments, let's say. So how does, or what is the usage of this collection scorecard? Primarily, there usually is a collection team in a bank for those customer who have missed payments. Let's say you take up a loan and you miss 1 payment maybe. So the bank has a list of actions they can do. Maybe they can just call you, send an SMS, or maybe send some recovery agent to your place as well to talk to you and recover some amount, right? So this collection scorecard will tell you the what is the probability of an already delinquent customer to not pay the loan or pay back the loan, basically. So if the collection score tells me that a particular customer will be able to repay back those missed payments, then the bank might do what? Maybe just drop an SMS or send an email and just get done with it, because the customer will most likely pay back on their own, right? But if the collection score tells me no, this is a risky customer, he's not going to pay back maybe, so the bank will take some rigorous measures. Then they might send some recovery agent, send some notice, some legal notices maybe. So the bank will take some aggressive steps in that matter, right? So this collection scorecard basically helps you optimize the or helps the bank optimize the collection costs and the collection efforts. If the collection efforts are streamlined, the collection costs go down. So that is the primary goal of a collection scorecard. And also to understand some early warning triggers of these delinquent accounts, whether they will actually roll into default or not, right? So this is the entire space of credit risk scorecards, where there's a score, B score, and C score at each point of time in the entire life cycle of a customer.
Okay,
So there is
Kushal,
Hmm.
we have one question here. So
Hmm.
basically, the guy or girl is asking that
Hmm.
he or she has heard that spending more on credit cards
Hmm.
results in a reduction in credit score.
Right.
So the question is that why is it and why not vice versa?
Hmm. So whoever has asked that question, that is a very correct thing. So that is what we call as utilization, basically utilizing your credit limit. Uh, so let's say you have a credit limit on your credit card of 1,000 rupees. Now you have spent 800 rupees out of it, right? And there are chances now when you have maxed the credit limit of your credit card, there's a high chance you might not be able to pay that back, right? So going ahead in the next 3 months, 6 months, 12 months, there's a high likelihood that you might not be able to pay back the due to the bank on your credit card. So that is why it becomes a risky customers, which reflects on your credit score. Your credit score goes down when you spend more. It is usually advised to keep your spending to around 30% or for 35% of your credit limit. But once you keep spending more, that's a trigger for the bank. Okay, this customer is spending more on his credit card. Not sure why. If he doesn't have the capability to pay back, it can go into default and can incur a loss for the bank. So that is why it reflects on your credit score as well. It reduces the credit score.
And also just to add, so
Hmm.
why this is seen as a negative thing? Because ultimately credit card is a loan, right? You are taking out a certain portion of loan out of the bank. So if you are using out most of your credit limit, so bank perceives as if that you are living on debts. So basically, you 80% of the total limit or 90% you are using. That means you do not have that liquid money. Hence, you are very much reliant on the credit card itself. So you are maxing out your card. So that is perceived as a negative thing, because that means you are over reliant on the credit card. So that is the thing, which is why this is, I mean, what we have heard is correct to summarize, and this is how it is perceived. So yeah, I think, does that answer the question? I think. Okay, I will take the silence as a yes. And just to give a disclaimer that we initially planned it as a 1 hour, like we said, we are doing it for the first time. So it might run out for run and extend for few minutes. So I mean, if hope you are if you are think that there is some validation in it, I would like you to stick around for, let's say, 5 or 10 minutes more, and we really apologize for the, I mean, the extension. So we'll keep this as a learning and try to be more precise and find to the time that we promised. So yeah, I mean, I would request everyone patience, and maybe it might run for 10 to 15 minutes more. Okay, I think we can go to the next slide.
Okay. Okay, so I'll just maybe quickly go back to the previous slide that we once discussed. So these are the two modeling landscapes that we talked about, right? One is the decisioning aspect or the scorecards, which we talked in detail in the previous slide. The other aspect is the loss or reserve management, where we spoke about the expected credit loss. So let's get there. So what is an expected credit loss and what do we do for it? So as I mentioned, so once certain loans are granted in the future, some accounts might default and some losses might come out of it for the bank, and that needs to be measured, and that is what we call as expected credit loss for the bank. And to measure that, there are three major components to it: the PD, EAD, and the LGD. So we'll break it down to you what a PD is, what a EAD is, and what a LGD is. So let's start with the PD first. So I personally believe that PD is probably the most important component of all these three factors, right? And PD is basically probability of default. What is the probability that an account will default in the near future at any given point of time, right? And the bank needs to answer this question for every account. Okay, but how do we answer that? So to answer that, there are a lot of factors that goes into a PD model, and it can be broadly categorized into two parts. The first one is the account characteristics, right? And if I talk about a few examples of account characteristics, maybe the first would be a delinquency status, which is basically missed payments. If let's say the customer has missed a few payments, one or two payments in the recent past, maybe in the last 6 months or 12 months, there are chances that he might again miss some payments in the future, because that's a trend for the customer. And there might come a time where he might actually go into default, right? So that can be a trigger for a customer, or trigger for the probability of default. It can influence the probability of default. Another account characteristic can be a bureau score. Let's say if I'm developing this PD model for my bank, okay, for let's say Citibank, I only have the information of this customer with respect to Citibank. Whether if he has some previous loans with Citibank, I'll have only that information. But what he is doing with other banks or other loans that he has outside of Citi, I don't know about that. So bureau score will tell me about it, bring in that flavor, that if he has some other loans in some other bank, if he's doing something wrong there, or let's say if he's missing payments there or going into default in one of those loans with some other bank, there are high chances that he might get into default with my bank as well. And I need to capture that information in my model, which is why some banks include bureau score in their PD model as well. The third component can be utilization. Just the question someone asked in the previous slide, right? Higher the utilization, it's a risky proposition, right? Again, 1,000 rupees credit limit. If I'm spending 800, I'm 80% utilized. I don't know, or the bank doesn't know if if he can pay back those 80 to 800 rupees or not, right? So higher the utilization, the higher the riskiness, and higher the probability of default. So like these, there can be other account characteristics or account attributes as well, which can contribute to explaining or predicting the probability of default of a account or a customer. So now these are the account level characteristics specific to that particular account. Now there's another component called the macroeconomic factors, like what is going on in the economy. That can have a direct or an indirect effect on the payment behavior of a customer as well. Let's say the unemployment rate suddenly goes high in the country, which means more people are losing jobs, which means there are chances that your customer also loses a job, and that can lead to a failure of the payment behavior of the customer, and that can lead into default basically. So the macroeconomic factors also become very important in terms of predicting PD. There can be other macroeconomic factors like GDP, housing price index, and so on. Some of them can be included based on the portfolio or the region. But the idea is account characteristics plus macroeconomic factors, giving you a robust probability of default model or a PD model. That will help me answer the question, what is the probability that an account will default in the near future? right? Now the next component, EAD. So the first component, PD, helps me answer what is the probability of an account defaulting in the near future. But I don't know with what amount the account will default in the near future. So that my EAD model will tell. It is basically the amount the account will owe to the bank at the time of default, right? And this needs to be measured and fits into the ECL framework. Okay. So now how do we measure EAD or exposure at default, right? So it can differ based on the type of products. Let's say there are certain fixed EMI products. What do I mean by fixed EMI product? A personal loan or a car loan where I have a fixed EMI, let's say of 10,000 rupees every month. So I know what my particular EMI is for a particular month. For them, I know if let's say I have a 5-year tenure, and each month I'm paying 1,000 rupees or let's say 10,000 rupees. If I default after 1 year, I know I have 4 years of remaining payment left. So I can easily quantify what is my remaining balance or remaining exposure at the time of default. So it's pretty simple for the fixed EMI products, but it gets difficult for the revolving products. And by revolving products, I mean, let's say a credit card where I am given a credit limit, but I don't spend the exact amount every month. This month I may pay and spend, let's say, 100 rupees out of 1,000 credit limit. Next month it can go up to 200. And again, the third month I don't spend anything at all, right? So that is not fixed. And for that, we need to have a different methodology to estimate the EAD, right? So there are certain popular metrics in the industry, like the CCF or the EADF. CCF is basically credit conversion factor. EADF is simply EAD factor. Either of these two are used for revolving products to estimate the EAD. Okay, I'll not go into like too much of a depth of how these CCF and EADFs are estimated or modeled, but just to give you a high level idea of what these CCF or EADF are, it basically tells you uh, out of your credit limit for a, let's say for a credit card, out of your credit limit, how much will you be spending or how much you will have spent at the time of default. Let's say today I have my credit limit is 1,000 rupees. As of today, my utilization is only 100 rupees out of 1,000. But by the time I default, my credit limit can be 500 rupees. So the CCF and or EADF will give me that value or that fraction, 500 by 1,000 in some form, right? So there are different ways to estimate CCF and MC or EADF. Basically, you can either take some historical data and take some historical averages of EADF or CCF and use that to predict the future, or you can build a statistical model as well using certain factors that can help you predict the CCF or the EADF, maybe some decision tree model or something, right? But either of these two methods, you'll get a fraction at the end of it, either CCF or EADF, which will basically tells you basically that 500 by 1,000 thing, right? The fraction with of utilization with which you default, and then you can multiply this back with your credit limit to get the actual EAD amount or the actual exposure at default amount, right? And now if you look at this formula below right here, where we multiply the PD into EAD to get the gross credit loss. So let's say for a customer, let's say the PD is 20%, chances of default is 20%, and EAD is 500 rupees or $500, let's say. We multiply them together, we get the GCL or the gross credit loss for that particular customer. Okay. So then comes the third piece, LGD, loss given default. Now, what we just discussed, let's say a customer defaults with a balance of 500 rupees. But it's not necessary the entire 500 rupees will be a loss for the bank, because as we discussed during the collection scorecard, the bank will have certain recovery measures or collection measures in place where they will send some people, try to reach out to the customer and recover certain amount of of that 500 rupees with which he has defaulted, right? So when we take out that recoveries that we can make, let's say he defaulted with 500 rupees, and over the next few months, the bank makes certain efforts and is able to successfully recover maybe, let's say, 150 rupees. Then the remaining 350 rupees that is not recovered, that is your loss given default. That is the final loss that you're making, right? So it highly depends on the recovery that you're trying to make. or the recovery rates that the bank are successfully able to achieve from the defaulted customers. And if you look at this formula here, LGD is equal to 100% minus recovery rate. Recovery rate is basically, as I said, maybe if I'm able to, out of 500 rupees with which I'm defaulting, I'm able to recover 150. So 150 upon 350 is my recovery rate. And if I deduct it from 100%, that is my LGD rate, my loss given default. That is the 350 out of 500 rupees with which I defaulted in the first place. Now there are different methodologies to model LGD. Again, one of two ways: either you take some historical data and take an average and use that average to use in the you predict in the future, or develop a statistical model based on whatever your requirements are, or depending on the kind of data that you have. But this is the definition of what LGD is. And if you come down to this formula, we had GCL, or gross credit loss, coming from PDEAD. Now we multiply it with LGD and we reach to the final net credit loss, or the expected credit loss, right? So just to summarize again, we had the PD, the probability with which the account is defaulting. EAD tells me the amount with which it defaults, and LGD tells me if I'm able to recover something, what is the final percentage of amount that will go into loss. And all these PD, EAD, and LGD multiplied together gives me my ECL, or expected credit loss. Right. So that's the entire framework of ECL. Please tell me if you have any questions.
Kushal, I think in the interest of time, we can move ahead and we can keep a 5 minutes slot maybe.
Sure, sure.
Last. Yeah. Okay.
Okay. So, okay, fine. So, when we spoke again, just going back to the reference of the model landscape, we spoke about under the loss or reserve management, we spoke about two categories there. One was the ECL, which is a normal scenario where some accounts of your portfolio will go into default and you incur some loss out of them. There was another part there about the stress situations, where these are extreme situations where different mechanisms or different efforts have to be made by the bank to mitigate those losses, and we'll talk about those losses in the next slide. So Krishna will take you through the aspects of this particular thing. So yeah, over to you, Krishna.
Yeah, thank you so much, Kushal. So, yeah, so before starting with this slide, maybe I'll give a brief introduction of what we want to discuss in this particular slide. So, I think before this, we started discussing with scorecards, or what are the type of what are the components of expected credit losses, right? How are these modeled? But the basic question is, why is this exactly required? What is the basic motivation for banks for doing this? One thing is, yeah, definitely banks would like to know the projected loss so that they can be prepared. But what is it that is driving the banks to do this, right? So here comes the regulatory landscape for credit risk. So for every bank or in every geography, there is some kind of regulations or regulators in place who are looking over these kind of requirements for credit. We're talking specifically about credit risk here. So there are some banks or some regulations which are in place who are driving these banks to model these. And to meet these mandates, these banks are required to model these type of credit risk. So before we go and discuss the regulations in place, so one thing is, like for example, for India, like the banks in India, the regulator who is in charge of overseeing the basic functioning of the banks in India is RBI, right? The Central Bank of India, who is overlooking all these type of requirements for India. Similarly, for US banks, there is the Fed, the Federal Reserve is there, and similarly, there is OCC, who is looking over all such type of requirements. For Europe side, there is the ECB, European Central Bank, and there is FINMA, and so on. So there are regulators everywhere who are guiding these banks how to be prepared for any kind of loss situation, so that the bank doesn't fail or go insolvent. So, in broader terms, there are few regulations, a few guidelines which are in place, which are very commonly used. So one of them is IFRS 9 and CCL. So these are basically the accounting standard. When we say accounting standard, bank has to maintain a book of accounts, right? Which has a balance sheet component, which has a income or P&L component. So this is introduced so that in the books of accounts, somewhere the credit risk, which is there for the bank, which is already present for the bank, that is accounted for in these banks, in these books of account. So these accounting standards are provided by IFRS 9 or CECL. We'll talk about it in brief later on. And then coming to capital management of the banks, these are accounting standards which we discussed. And we have something called capital management, how bank manages its capital. So for that, we have a common guideline across the globe, which is the Basel guidelines, the Basel norms, which we call. So these lay out a lot of provisions or a lot of points which we need to keep in mind when banks are modeling these type of losses. Again, we'll talk about it in terms of losses or what Basel says about these kind of losses briefly later. And then comes stress testing, as Kushal already discussed. So we'll discuss these things in brief. But before that, let's understand what is expected loss and what is unexpected loss. So in the previous slide, we discussed how to calculate expected loss. So we separately model what is PD component, that is the probability, and what is the exposure at default. So multiplying any value by probability will give me the expected value of the losses, and I subtract the LGD or the recovery from it, and I get the net credit losses. But where does this fall in the entire bank's view, right? In the entire bank's loss distributions, how does these losses look like? So here we have a probability distribution curve or a PDF, what we call. So this is for the potential credit losses of the bank. So if you see the x-axis, we have the potential credit losses and it keeps on increasing towards the right. It starts with the value 0. Sorry, Kushal, I think Jennifer is saying the PPT is not readable. Can we zoom it a bit?
Yeah, let me try.
Yeah, is it better now, Jennifer? Okay,
Yeah.
so looking at this PDF function, so we have the potential credit losses. What can happen over the time for a particular bank? Say it increases towards the right. Maybe it starts with 0. And for a simple example, it can go for 5, 10, 15, 20, and so on. And on the y-axis, we have the frequency of these losses. So for any corresponding loss, I have a corresponding frequency. So that is why this is called a probability distribution function or PDF. Now, to take a very small example, consider a restaurant's business. I run a restaurant's business and I buy my daily supplies, imagining or because I know from the history that on average I'm expecting around 10 people to come to my restaurant to eat. So I buy these supplies accordingly. Now, what is the thing that can happen? What can be my loss on a very frequent basis? So, say out of these 10 people which I'm expecting, it might happen someday 8 people turn out or only 9 people turn out. So, my supplies for the remaining 1 or 2 people will get wasted, right? So, that is my loss from a restaurant's perspective. That is something which I'm losing here. And it might happen a customer breaks a plate or utensil. So these type of losses are expected to happen very frequently, in almost on a daily basis or on a weekly basis, right? Very frequent. So this type of losses is something which I'm already prepared for right from the beginning, right? So these are my expected losses. So if you see in the loss distribution curve, the frequency of these expected losses is high. It's towards the peak of the curve. So the thing about expected losses, the magnitude is relatively small, but the frequency is very higher. This can happen on a very frequent basis. So that is expected loss. Now coming to unexpected loss. So before going to that, from Kushal, uh, can you put it on slide mode?
Yeah.
Yeah. So when we talk about expected loss from a bank's perspective, it's like the average credit loss which the bank is expecting while giving or extending credit to its customers over a given period. So similar to the restaurant's business, whatever the bank is expecting on a daily business or a regular business run, whatever loss is expecting, that is the expected loss. Now coming back to the restaurant's business, say I have a monthly profit of 400 rupees, and from history I know that I am making I'm losing over 20 rupees like in a month because of these things, like either people are not exact the amount of people I'm expecting they're not coming, or maybe some people are breaking the utensils or whatever. These expected loss, I know these are 20, these sum up to be around 20 rupees or 30 rupees. So what I'll do, because this is a small amount which happens very frequently, whatever profits I have, I'll keep some amount as provisions. So so that my expected losses are covered because I know about this. So provision is something which I keep from my expected for my expected loss and from my profits. And these accounting standards which are there, like IFRS 9, CCL, they provide the accounting principles for doing this, so that in the books of accounts somewhere this type of credit risk is reflected. Now again, we'll discuss IFRS 9, all these things in details maybe in another video, because they have a lot of technicalities which we might have to go into. But in general, this is how we cover expected loss using IFRS 9 or CCL. So the difference is CCL is majorly used for US banks, and for the remaining geographies we have IFRS 9. And this uh, CCL is generally prescribed by the FASB and the Financial Accounting Standard Board, and IFRS 9 is generally prescribed by the International Accounting Standard Board, and it's applicable for remaining geographies. And one basic difference, if I have to talk about, is IFRS 9 follows a staging behavior. So, as I said, we have to keep some provisions out of my profit to cover these expected losses, right? So, first, IFRS 9, what IFRS 9 does is divides into stage 1 loans, stage 2 loans, and stage 3 loans. Stage 1 loans are relatively less riskier loans, which have not deteriorated in conditions. They are in, as Kushal was saying, there are DPTs, right? Delinquencies past due. So if someone is just in current, like no default, they have not missed any of the payments. So they're in the current bucket. So they may be in my stage 1 accounts. So for them, I don't keep a lot of provisions. What I do, I keep just provision for 1 year to cover these type of expected losses for stage 1 accounts. Now for stage 2 and 3 accounts, when we talk about stage 2 and 3 accounts, they are relatively riskier loans. They have deteriorated in condition. They have moved from different buckets. From maybe the stage 2 loans is in the initial DPT baskets, and stage 3 loans have almost moved towards default or have already defaulted. So that is how I discuss the staging in IFRS 9. And there I find a lifetime of these loans. What is the entire lifetime of these loans? And I keep a provision which is relatively larger compared to my stage 1 provisions, and I keep this provision for the entire lifetime of these loans. But in CCL, there is no such staging. We keep the provisions for the entire life of loans for all the loans. And that is, as I said, majorly applicable for US banks. Now, this is expected loss. We have discussed how to take care of it. Now what happens, like coming back to my restaurant business, what happens if there is a natural calamity, if there is an earthquake and my restaurant is damaged partially or fully? That is something which I've not expected, which I've not accounted for. I think things are going fine. This is not what I thought would happen. So that is something unexpected. And if you see in the loss distribution, the frequency is very low compared to the expected loss, right? It lies towards the right of the frequency distribution, and the frequency is very low compared to expected loss. But if you see the magnitude, it's very high compared to the expected loss, right? So in such a case, what will happen is I need a lot of buffer or capital in place to cover this type of loss. Maybe my profit won't be able to cover it. So it's like a bigger magnitude, smaller frequency loss. So Kushal, can you click once? Thank you. So in terms of banks, how we define unexpected losses, it's the volatility or the variance from the expected loss. This is expected. How much does it deviate? Like how much does the unexpected loss deviate from my expected loss at a given confidence interval? So if you see, there is something called a worst case loss under normal circumstances. That means the situation is normal. Like there is no economic disruption or anything. The macro scenario is going well, but there is some unexpected event like earthquake or any natural calamity or anything which is not expected or I have not accounted for. So basically in terms of banks, what bank does is finds out a worst case loss and subtracts the expected loss from it to find this unexpected loss. So whatever is remaining is unexpected. So for unexpected loss, because the magnitude is large, even though the probability is low, I go for capital planning. So, and for this, we have a regulatory framework like Basel, which is a general guidelines which is applicable for applicable to most of the banks. So there, it's it's ensured that banks are adequately capitalized to absorb these kind of unexpected losses, and economic capital is maintained for that. Again, for economic capital, the modeling is quite different. It has a specific set of modeling even to find the worst case scenario. We'll try and see if we can come up with more webinars or more videos on these things later. But just for a basic or from a layman perspective, economic capital is something that is kept to cover any such unexpected losses. Now, why do banks do this? It's mostly driven by risk tolerance of the bank. For example, like our parents might be more risk averse compared to us, so they keep more buffer or more investments or capital in place compared to young people who generally believe in spending more. So it's similarly, it's driven by bank's risk tolerance. If a bank is more risk averse, they'll keep more economic capital to cover such unexpected losses. And if a bank is not that risk averse, they'll maybe keep slightly lower economic capital. Again, it's backed by models. Now, the basic reason behind economic capital is my bank is always in a going concern. By going concern is mean bank is never insolvent. It keeps going or it keeps running. Even though a earthquake comes and my restaurant is damaged, I ensure that I have enough buffer so that I can continue with my restaurant and doesn't get bankrupt or insolvent uh, because of that unexpected loss. So that is the motive behind capital planning. Now coming to stress loss, if you see. So Kushal, request you to class time. Thank you. So stress loss is something which is majorly which is affected by the economy. For example, if you see in this is stress testing is something which came into picture, which came into the purview because of the 2008 financial crisis, when the all the banks went into stress, or similarly as we see in the recent pandemic time, right? So coming back to my restaurant business, if the during the COVID time or during the pandemic, if lockdowns happen, uh, almost none of the customers will come to my restaurant, right? And it's something which is affecting all the organizations around me. It's like a factor which is affecting the economy in general. So the economic factors which affect my bank, that is called stress loss, under extreme stress, and these come under the tail loss. So this is basically to test the risk if the banks are adequately capitalized to cope up with such type of economic stress. And this is generally forward looking. Like it gives me a overview of what will happen in the next few quarters, and accordingly if I'm prepared for it or not if such thing happens in future. So coming back to the graph to summarize this, so I have something which is expected loss which I'm already expecting. Then I have a stress loss which is to cover if there is any turmoil in the economy which is affecting everyone in general, the economy in general, GDP, unemployment rate, anything. It might happen if there is a severe stress. These factors might um, vary significantly. Like unemployment rate will go up significantly, GDP will fall, and for example, like a retail loan or a credit card loan, people won't be able to pay back. So again, the defaults will increase and my loss will increase as a bank. So for those losses, I keep stress loss. And anything in between these two losses is something which I keep as unexpected losses as economic capital. Now, how to find these losses is a separate topic where we delve deeper into the models. But to understand a little bit more idea about stress loss, because we have already discussed how to calculate ECL using PD, LGD, EAD. Since we have already introduced to what is PD, what is LGD, what is EAD. So, for example, let's say I take PD model. So, as we discussed, PD has a behavioral specific variables which generally do not vary with the economy suddenly. Like, for example, utilization or other credit score or other things. They don't fluctuate too much with the economy. But then that is why in the PD model we have a set of macro variables in place so that we can figure out what happens if the economy fails or the economy goes into severe stress, what will happen to my defaults ultimately. So generally, for example, we have in stress testing these regulatory bodies, like for example Fed gives for US, or for US bank Fed gives these scenarios which is called, they have something which is called a CCAR stress testing. I'm sure many of you are pursuing FRE must have heard about CCAR. So comprehensive capital analysis review. So what they do is Fed gives this forecast for macro variables for 9 quarters in different scenarios, like baseline scenario, like if economy functions as usual, it's a baseline. What will be the macro scenario for the country? Similarly, a adverse scenario where if things go a little downturn, what will be the values of GDP? How will the unemployment rate grow? It gives me a scenario. Similarly, for a severely adverse scenario. So as we saw in the PD model, it has both behavior specific variables and the macro variables in the logistic regression, which We just feed, after we build the model, we have the equation. We just use the macro scenario data, which is provided by the Fed, say in this case, since we're taking the example of the US. So we feed in that particular data for the macro variables forecast, and we forecast our PD in different scenarios. What will be it in baseline? What will happen if it's in adverse condition, or what happens if it's severely adverse condition? And accordingly, we test if the banks are adequately capitalized. Now, the stress testing thing, it's not generally restricted to the loss forecasting. It has several other things which they practice, for example risk management practices or other things as well. But here, since we are focusing specifically on credit risk, this is how the test for credit risk, if my models or my risk management practices are sufficient enough or are good enough to handle such kind of stress in the economy. So to summarize, there are three types of things happening. One is the provisioning requirements, which is for the accounting standards, which is described by this IFRS 9 or CECL. And then there is the capital planning, which is determined by the Basel norms. And then there is stress testing. So this is how my entire credit risk loss is distributed for the bank. So any questions, any comments, opinions on this?
Yeah, I think we have reached the end of our session, and I think Kushal and Krishna, I would like to thank you for such informative things. Yeah, I mean, now we'll open the floor. We'll ask anyone to have any specific question in this last slide or anything in general. We'll have 5 minutes of Q&A, and maybe yeah, then we can conclude our session for today. Anyone who has any question can post it in the chat, or they can unmute themselves and also ask, I mean, talk in the forum directly. Okay, we have a question from Bhargav. The question is, what qualifications do you look for while hiring for entry-level roles? So anyone, or if you want to take it, or anyone else?
So does your question is like what qualification is required for any banks or any consultancy firms for this credit risk domain? I assume that.
I think that is the question.
Mm-hmm. So the qualification, so they see there are what we have seen in a based on our experience, there are two kinds of people work in the banking or the consultancy domain. So one is your who are the stat or economics grad, those people, and another one who are technical, who are not stat or not eco, but they are from the engineering backgrounds, but they have done some for certifications like CFA, FRM, or done some MBA in finance. So all these kinds of people, all kinds of these kinds of people generally are hired in the banks or the consultants. So Bhargav, if you have any question or you want to ask follow up, you can speak also.
I think he has said, okay, thanks.
Okay, thanks.
So yeah, yeah, I think we have kind of summarized. So basically, what we generally look at an entry level is that some basic knowledge. I mean, the qualification part, auditor has already covered it. But on the information side, I would say more than the qualification itself, what we look at is if they have a strong background on the basic concepts which are required for a credit risk domain. By basic concepts, what we mean is the basic classical statistical concepts of probability, of hypothesis testing, then classical modeling techniques like linear regression, logistic regression. So these are kind of the must-haves that we kindly look at. So yeah, I mean, and some amount of knowledge in the finance domain is an added advantage. Since it's an entry level you are asking, we might not also clearly look out for someone who has very much out and out knowledge, but if someone has, it is really good. And like we always try to say, this domain is a mix and match of quant and coding. So coding is something we also look at entry level. some amount of coding experience in any of the coding that we generally use, mainly SAS or Python or R. I would more emphasize on SAS and Python. In the credit risk, still SAS is being used, but I would say slowly we are transitioning into Python. So some amount of basic coding experience and knowledge is also what we are looking at the entry level goals. So Bhargav, I think, does that answer your question? Okay. Okay.
Any more
Another,
questions from anyone?
yeah, another thing we have got no question from me as well. It's just that the concepts covered are so many, so I have to study and cover every single topic. Or will
I
be
think it's Said again.
okay, no problem. Yeah, I mean we have just tried to keep it a very generic one. So we will try to conduct more sessions based on our availability. We will dig deep into each of these concepts and we'll try to walk you through each of the concepts like PD, EAD, what are the modeling frameworks. So I hope this has been a little bit of value addition to your experience and knowledge. And anyone else? Anyone have any questions, or I would make the concluding statements and maybe we'll call it a day. Okay. I don't see any more questions. So yeah, I mean, again, I would like to thank everyone, especially on a Sunday evening. You had the time to join a session for 1.5 hours. I know it's well past the mark we have told. We have provided, but yeah, I hope that it was something which has made some value addition. And after this thing, we would like to take some feedbacks from you as well. So we'll share some sort of questionnaire or feedback form. Do let us know what are the topics we want to hear about in the next sessions. And we have also our LinkedIn pages. We also have our YouTube pages. We also have our Instagram pages. So do follow them. We keep on posting things on a very lucid manner as possible. So maybe we'll share those as well. So yeah, thanks everyone for joining again, and I hope you have learned something out of it,
Yeah.
and yeah.
I think if you actually like this, or if you want us to add more information or focus on any specific topic or any feedback, you can comment on our LinkedIn post for this particular webinar and let us know what you felt about it, or where you felt we should explain more or add more. So that would be great to have from all of you. And yeah, as Shubhadeep said, we'll try to put up more detailed videos or these type of PPTs on LinkedIn and YouTube page so that it can be referred later on.
Okay, and then we'll call it a day. So again, so thanks everyone, and have a great day.
Thank you. Thanks, everyone.